This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty checking in exactly at 8 p.m. Eastern Time for our monthly open house Q&A session. And if you're brand new to this format, understand this is an interactive session for those who are participating live. However, it will be recorded for our members and then posted to the member page. So if you are a member of the Option Oracle, the Equity Oracle, you'll be able to get the recording of this and not have to take such stringent notes. This is a one-year daily candle chart of the spiders, the S&P 500 ETF. And if you were following along with last week's market report, which I put out, well, actually I record it every Friday after the close, and then either Kenny or Bill, who do the production side of it, they either send it out Saturday morning or sometimes Saturday afternoon. But it is recorded. That too is archived because I want a standing record to be in place so that there's no questions as to the accuracy of candle charts as a forecasting tool. Now, years ago, when technical analysis was coming to the forefront, the fundamentalists who would rely on company analysis and reports from the underlying companies, they looked at technical charts and said, "Oh, you can't forecast the future with those things." And so what happened is the technicians back in the late 80s, early 90s, and even into the mid 90s, they took a more of a defensive stance. And instead of trying to defend the accuracy of it as a forecasting tool, they promoted it more as a risk management tool. And I say you could do both. And the reason that I record these weekly market reports especially is so that people can go back and check the accuracy for themselves. And what we have here are the lines that I drew last week. So this line that I'm highlighting right here is what I forecasted last Friday. But this line here was my forecast from the week before. And that was the first time that I did that, where I left two lines up so you can see the progression of the forecast. So here I said the market would go down, and usually at the end of my line, that's usually my target price. And you can see here on Friday, the low came within pennies of that target price. And then on the close on Friday, I highlighted this hammer pattern, which is a small bodied candle. That red body is what I'm referring to there, with a long shadow or vertical line under the candle. And I said, well, that is a bullish signal. And usually when you see long shadows under the candle, it generally means that the market will move higher. And so I drew this line as my forecast. And here it is Monday, and I've already surpassed my target. This line up here, if you didn't get a chance to watch the report, this is a resistance line that I'm going to keep an eye on. Now, the traders at the end of this week will get, obviously, my report on Friday for what I think next week will look like, but I'm going to give you a little bit of a sneak preview. The key in forecasting, again, if you're using it as a forecasting tool, is to monitor price and volume and how those two, price and volume, relate to one another as the price is moving to key resistance or even support levels. That is extremely important, that you look for resistance, you look for support, and then monitor the volume as the price reaches those areas. So here, a couple of things happened today. Not only did we move up with a strong green candle, and almost hitting our resistance point up here right around 245, but we gapped up on the spiders, and we did so on lower volume. Now let's test the audience. Who are the veteran subscribers who can tell me what that means when a stock gaps up and it starts hitting resistance on lower volume? What does that tell us? Can anyone highlight that? Let me see. I get a little bit of a delay coming in, so I'll wait for an answer. When the price is moving up towards resistance and we see that the volume is dropping, Gil says 80% chance of the cases it rolls back. And yeah, there's a good chance it'll pull back. Bill says no buy commitment. Yeah, that's another way to put it, Bill. David is answering the question more in line with the way I would answer, is that the buyers are running out of fuel. Amalia says bearish divergence. David says gap will fill. That's true. 80% of the time the gap will fill. Lloyd, again, he's been on a lot of these webinars, says the buyers are less motivated. That is true. And Ann says 80% chance, I imagine, of a change. So all of you are accurate. Now, again, when I see prices going up on low volume, I have to be cautious. That's all. I'm not telling everyone to stay out of the market, because there will be isolated buy candidates that we can get into, even though the S&P or the Dow might seem a little bearish. We can still take long positions, but you have to watch out for the overall market. And this week, I believe it's Wednesday, I don't know the date, but I saw a report that there's a good chance the Fed is going to come back this week again and raise rates again. Okay, so now here we are looking at the charts. They're looking a little bit more bearish than bullish, and this is all happening ahead of the Wednesday Fed announcement. So the charts are, in fact, forecasting a possible downturn. And if the Fed raises rates, that is going to put more pressure on the market. And so we have to keep an eye on this blue line, which is the 20-period moving average. So these are all things that we consider, along with divergences or price movements away from the moving average. We call that the rubber band effect. We have to consider all those things when we're forecasting. Okay, so that's the S&P. Now, if I look at a more broad-based index, which is the Russell 2000, this represents 2,000 stocks. And there, again, is my forecast from last week. Last Friday, I said I believe the markets would move up, and this would be my target. So today, we came, I think, within 2 cents of my target price already. And again, I highlighted that hammer pattern with the long shadow underneath. And you can see, again, the evidence is clear. I mean, there's no debate whatsoever that if you go back in the past and you look at these candles that have these long shadows underneath, you could see what's happened to the price after these long shadows show up. Boom. This is an amazing hammer pattern where the Russell 2000 had a nice and almost vertical rally here. And again, look back. Here's a hammer pattern. It rallied. Here, not necessarily a hammer pattern, but a long shadow underneath the candle. It rallied. Go back even to the beginning of the year, and you'll see even the smaller moves, vertical moves up here on this day. This is back in September 2016. Small little body, long shadow on the moving average, and it went up. There you go. Even on very short rallies, we can more or less forecast them if we pay close attention to these long shadows. Now, does that mean that every single time you see a long shadow at the bottom of a candle that it's going to go up? No, of course not. There is never a 100% sure thing in this market. This is all based on probability and outcome. What's the probability of the market going up, or what's the outcome? The probability is it'll go higher, and here's the outcome. Boom. Pure statistics if you're analyzing the market that way. So I'm going to keep this in place. This RUT does not measure volume, so we don't have anything to measure against the price, but we can see a clear area of resistance up here for the Russell, right around 1425. So keep an eye on that. If we see any kind of a pullback, or here we go, a vertical shadow, a long shadow above the candle is bearish. There we go. It's just the opposite of what we're seeing on these hammers. So if we see the Russell 2000 move up and maybe even trade over that resistance, and then towards the end of the week we see a long shadow above the candle, that gives us more of an insight to lower prices down the road. And by the way, the Russell 2000 carries more weight than the Dow. That only carries 30 stocks, and the S&P carries 500 stocks. Russell 2000 stocks carries a lot more weight. So when you see big long shadows either below the candle or above the candle, you just can't ignore them. Okay, let's look at the Qs. That's the power shares, and then we will be going into your stock. All right, so here's the Qs, and my forecast for the Qs is that we would go a little bit lower, and we didn't do that, but we're already gapped up. So the Qs have gapped up, the diamonds have gapped up, and the Russell 2000 just moved up. It didn't gap up. So now what's happening here with the Qs, because this is the tech sector, this took a beating last week, is that now we are down below that blue line. Who could tell me what the blue line represents? What moving average do I normally use and promote? The blue line right here. Can anyone answer that? Yes, you all got that right. 20-day moving average. Now, the concept that I talk about all the time with regard to role reversal, that is when resistance is broken, it turns to support, and when support is broken, it turns into resistance. This concept also applies to the moving average. Here you can see a very clear a bearish engulfing pattern where it came up, tested the 20-period moving average and failed. Now look at what's happening again. The NASDAQ is moving up to the 20-period moving average, but look at the volume dropping steadily. So I do believe that the NASDAQ is going to start to roll over. So what does that mean? If you have any tech stocks in your portfolio, you might just want to protect that. Use the 1% rule. Don't be a hero and try to turn a loser into a winner. And don't try to play or anticipate a breakout in a market that looks like it's starting to roll over. This is significant volume that we've had over the past week here. And the NASDAQ was really shaken up. This is one of the longest red candles. That was back on the 9th of June. That was one of the biggest red candles we've had all year. And you really cannot ignore that. And now that we're starting to see prices drift down below that 20-period moving average. If we start moving lower towards the end of the week, then this moving average is going to start to curve lower, and that shifts the whole trend. And you could see people, and including the fund managers, start to bail out of that. So be really, really careful with that. Okay, now let's go to, what am I missing? So I did the spiders, Russell 2000, the Qs, the diamonds. Okay, the VIX. Let's look at the VIX. Now with the VIX, my forecast was that we would move lower first before going higher. So today, again, the VIX came within pennies of my pivot point here. This is my target bounce point. So we're getting very, very close to that. The option traders are playing the VIX. We're currently down on that particular trade, but we're financing it with other positions. I think that when the VIX starts to pivot up and starts trading regularly over that 20-period moving average, we could see the VIX go from 10 to 11 and then even storm up to 16. It's not uncommon for the VIX to do that. So if you're playing the VIX, understand there's a lot of volatility in the volatility index. So be really careful with that. The fortunate thing for those who are long the VIX or playing the VIX long from the long side is that we are at record low support levels right here. Below 10 is record low, and I highlighted that in the option report. This is a 20-year chart of the VIX right here. And so we're on the 20-year lows. And if you were to go back 50 years, you'd see that it's lower than what we had 50 years ago. So we're on record lows right now, and something, again, you cannot ignore. Okay. Now, before I get into your stocks, and if you could just hold off 1 second before you start typing in your stock symbols. I'm constantly trying to learn new things, not just with the market, and I'm talking life in general, you know, and I'm going to use an analogy that might seem a little corny, but it definitely applies to stock picking. Today I went out into our greenhouse, took a little break from the market, just walked around with nature because I saw the storm clouds rolling in. I wanted to just get outside before the rain. And I went out and I took a walk down to the pasture and started tootling around in the greenhouse. And I noticed that there's a whole bunch of mushrooms popping up all over, not just the pasture, but even into the woods and around the trees. And they're not all the same. They're not all the same mushrooms. Now, I am not any kind of an expert whatsoever about mushrooms. In fact, I've always stayed away from them because I heard that, you know, there's poisonous ones and you got to know the difference. But there's just so many mushrooms out there that I decided I was going to go online and learn about where, you know, what are the good ones in Florida? What are the bad ones? What are the ones that get infested with bugs? What are the ones that stay clear of bugs? And as I started digging in, I realized that there's a whole science behind just the mushrooms and which ones you can eat, which ones you can't eat. And then just the way my mind works, I start applying this idea of mushroom selection to the stock market because my brain is I'm always in the stock market. I don't think there'll ever be a day for the rest of my life where I won't look at the market at least once or twice during the day. I just love the market. I just love watching it and following the stocks. But what happens is when people start picking stocks, a lot of people just do it haphazardly and randomly. And like the mushrooms, if you pick the wrong one, you're gonna hurt yourself. And so you have to really, really be careful that you're getting in stocks that have a history of making money and have a regular rhythm for price action. And let me give you one. This is one. LZB is one that that we put out to our equity traders. LZB is Lazy Boy, and we put out a buy last week on this one. It went up. It rallied nicely, but we held on. I didn't sell. I didn't put any kind of recommendation out to anyone to sell. It went up nicely, came back. I saw a bearish engulfing pattern last week, and I thought, you know, maybe we should sell it. There was a point here. I think there was a point close here. It was looking like a bearish engulfing pattern, and I didn't sell it. But I looked at it today, and I thought, wow, look at this one. Now, I'm using this as an example because Lazy Boy, popular brand, you know, a lot of people even own these lounge, you know, living room chairs, couches and such, furniture. And I see today, bam, what is that called? That's a hammer pattern. Small bodied candle, long shadow, really long shadow. And on Friday, it gapped down. It gapped down, closed below the 20-period moving average. And today, I'm pointing this out to you because it's very hard to ignore a signal like that, because that is a very, very strong signal of buyers coming into the market. Not only did they close it back up over that 20-period moving average, but it's happening all on really strong volume. You see that? So for the people that didn't get in, this is still a good point for our subscribers. For those who are in and have held it, it's really looking good. You see this? Now, again, there's no guarantee it's going to go up, but there's a high probability it will. So when I'm looking at a stock like this, what I do in forecasting is I say, okay, there's my forecast. And you might think, oh, he just did that randomly, but I didn't. What I did is I look at the angles at which the stock had traded in the past. You see, I'm kind of drawing my lines through these angles. So I take a low here and I draw here. I could take a low here and draw here. And you can see that these upward legs, as we call them, they're very short upward trends. They're pretty much at the same angle. See, this is, I'm guessing at maybe 50-degree angle. This is maybe a 49-degree angle. Maybe this is a 48-degree angle. This is a 45-degree angle. You see, so this is my forecast. And when I do forecast lines like this, I allow my eye to go back into the history to see what the pattern is. And again, the pattern is that when this stock has long shadows under the candle, very, very strong probability that it's going to rally, because in the past, it's not a regular occurrence that we see the long shadows. But when we do, again, look at this long shadow, you can't ignore them. And if you look at the upper shadows right here, see, there's a long shadow above the candle. Can't ignore that. That's bearish. Here's a long shadow above the candle. Can't ignore it. Bearish. Here's another long shadow. Boom. What happened? Very next day, it collapsed. Here's a fairly, not enormously long, but long enough to get my attention that, hey, you might want to get out of that one. So when I look at your stocks and I'm analyzing them, that's what I look for. I look for that. And I look for the divergences in price and volume, and I look at the divergences in price as compared to the moving average. So with all that said, I'm kind of laying the groundwork for you in how I'm going to look at your stocks. And we're going to take the same checklist, more or less, and apply that to all the other stocks. Okay, so let's go. Who wants to be the first one to put in? And if you could, give me a stock symbol. Tell me what your idea is, your intentions. If you have a position, let me know so I can help you better. All right, Ron says Cube, C-U-B-E. And let's look at that. Okay, well, immediately, Ron, I see that the stock is bouncing off of a key support level. That's a no-brainer. There's almost a double bottom. So this is a good thing for managing risk. The second thing that I see is that the stock barely closed over the 20-period moving average, and it did so on higher volume from Friday. So that's a good sign. Another thing is that we have two back-to-back candles with long shadows underneath. So that looks good. So if you're looking for an entry point, the stock is basically giving it to you now, but here's what I want to focus on is the exit point. See, if you do decide to get in because it's closing over the moving average or trading up over the moving average, you have to understand there's going to be two exit points. Here's a resistance target right there, and there's a support level down here. So if you do decide to buy it in this area and it hits resistance and you see the volume dropping, you might want to get out at 25.75 or 25.80. You know, so you're making what, $1.30? That's going to be maybe close to 6% return if it just gets up to this target area. Now, on the other side, you have your support level to help guide you from the risk management side of it. So if you buy it at 24.5 or whatever this price is here, you want to get out on a close below the support. It's really that simple. Now, we don't see any wide divergences from the moving average because it's right on the moving average. So there's your parameters, and you have to make sure you're your own best risk manager at that particular point. All right, Leslie says, do you use 50 and 200 daily moving averages? Leslie, I do only when I'm talking to investors, and what I do is I convert my weekly chart to the 50 and the 200. And the way I do this is a 10-week moving average is the same as a 50-day moving average, because there's 5 trading days in each week times 10 weeks. There you go. So a 10-week moving average is the same as a 50-day moving average. And when I'm looking at a weekly chart, a 40-week moving average is the same as a 200-day moving average. Because again, 5 trading days in a week times 40 weeks is 200 days. There you go. But I usually only save that moving average for investors. And I just I don't like putting them on, taking them off, putting them on. I like to keep my charts very clean. So most of the time, you're only going to see one moving average, and that's that blue one representing the 20. Okay, Sean says AES. Sean is short at 1190, so let's say AES. And shorted at 1190, so you short it right where the stock is trading. All right, so the good thing is you have the stock at a resistance point. The stock volume is dropping quite dramatically, telling us the buyers are drying up. You have a stop at 1211. I would agree with that because the stop is above resistance. And you have a target of 11.5. I like everything that you've said because the target of 11.5 is going to be right near the support level. So everything checks. According, if you're using me as a sounding board, I would completely concur with what you've laid out for yourself there as targets and risk points. Absolutely. Good job on that. Okay, Greg's is AGN. Greg, I don't know what your position is on that. But I can see already that there's a long shadow above the candle. You see that right here? And the stock has moved quite a bit away from that 20-period moving average. Now I'm going to show you something. I'm going to do something a little different. I'm not going to look at the volume right now. I'm just going to capture the price because I want to draw some double arrows on here. For those who are new, I want to give you a better idea of how I look at what's called the rubber band effect. And so if I go here and I pick a double arrow to measure from, and I measure the distance from the moving average to where the price is right there. Let me make this a little bit narrower so you can see that. Now, this is a drawing program called Snagit. So what this allows me to do is take the chart that we were looking at before, draw the arrow, but I could take this arrow and move it without the arrow changing in length. So I want to show you something. Here's the divergence from the moving average to the price. Now imagine the arrow is a rubber band. The rubber band is being stretched. Well, look back in the past at the other times when the market or that price moved away from that moving average. Again, that's the same length in the arrow here. Look. Oh, let me get rid of that one. Let me drag this one. There we go. Let me try to drag that. There we go. So look, see how the stock does not like to stay that far away from that moving average. Now, even on the downside, look, it does not like to move that far below before snapping back. So right now, with the price moving that far away from that moving average, there's a high probability chance that the stock is going to pull back to the moving average. That's number one. Number two, let me go back to my chart, is that we have a long stretch of green candles. We have 1, 2, 3, 4, 5 green candles in a row. We're long overdue for a red candle. So we have a long shadow. The other thing is this gap has filled. See, today the gap filled. 80% of the time after a gap fills, what happens? Oh, stock reverses. That's usually what happens. 80% of the time after a stock fills the gap, it'll reverse and go the other way. So it's not my opinion. It's based on what the charts are telling us. Everything so far is telling me that the price is most likely going to start dropping. So be careful that one. If you have it, you might want to take a profit. If you're thinking about shorting it, that might be an idea as well. Okay. Now, Pat says MO. Does MO have momentum? And Pat is long it at 76. Let's take a look at MO, which is Altria Group, formerly Philip Morris. Okay, now the same thing applies here, Pat. If you're long it at 76, you have to be very, very aware that over the past 5 days, the stock has gone vertical. You see that? There's no question it's gone vertical. And now today, the volume is half of what it was on Friday. So there's a very strong possibility it's going to pull back to that moving average. The rubber band is being stretched. Again, it's probably trading further away today than it has all year from that moving average. Here is an area where it was fairly stretched from that moving average. Today, it's stretched even more. And you got those 5 green candles in a row. So chances are we're going to see a red candle here soon. If you have a profit, that like you do, you might want to protect that by either selling half of the position, keeping the rest, and stopping, put a stop below the moving average. You might use options to sell some calls against it. There's a couple things you could do there if you're an option trader. If you're not an option trader, then I wouldn't touch the options until you learn about them. But this looks like it's going to be pulling back pretty soon. Now, I'm going to leave this. I'm going to leave these lines in place because by the end of the week, I'm going to go over the recording and I'm going to track my own percentage of accuracy based on what I'm telling you here on these charts. So I'll leave these lines up and I'll save them. Okay, so David, WDC. David, I won't be able to go through the whole list of stocks you give. If you want to pick one, go ahead and tell me what your position is. WDC, which is Western Digital, is going up to that 20-period moving average. It's going up, but it's going up on lower volume, and it looks like that 20-period moving average is going to bump its head against resistance there. So there's a good chance that could pull back. Be careful. There's bearish engulfing patterns all over this chart up here. I don't know if you can see that. I'll zoom in. You have a bearish engulfing pattern here. You have one here. You have one here. They're all pretty much lined up, and now this stock looks like it wants to go down. So I'd be very, very careful. Let me do one more for you, MU. Advanced Micron Technologies. Let's see. Let's see what that looks like. That one looks a little bit better because it's bouncing off the 20-period moving average. So that one looks a little bit better. Okay, let me see. What's the next one? Is David is looking at CMTI. CMTI. Hold on. CMTI. What's that one? CMTI. Community Medical Transport. Why isn't the chart coming up here? Interesting. Why is that chart not coming up? Hold on, folks. CMTI. Bear with me. I'm going to take a quick pause. I got to find out what's happening. Bear with. I'll go a little bit over on the hour. Hold on. Let me go to Deb. Deb is looking at JCI. Let's see. JCI. Johnson Controls. All right. All right. I think we got the problem fixed now. Just check my. All right, got a good Wi-Fi connection. Okay, now let's go through the checklist. Okay, now Deb, number one, the price is moving over the 20-period moving average, which is good, and it is doing so on volume that's building. So you can see how the volume is building on the buy side. That's good. The only concern that I have at this point is that there's a short-term resistance right here, right below 43. So you're only, what, 46 cents away from hitting that resistance. So if you're long this one, well, you think about buying it, but I would be very, very cautious about buying a stock as it's approaching resistance. Because if at any point you buy it here and the volume starts dropping, then it's probably going to pull back from resistance. That's number one. Number two, the rubber band, the distance between the price and the moving average is already being stretched. You see that? So you got to be extremely careful. If the stock breaks out of resistance here, over 43, and then all of a sudden you see a huge spike in volume, that's actually a better place to buy it at a higher level than to try to pick it below a resistance point. So be careful with that one. I would look for something that's closer to a support level where it's bouncing and better signals. And remember, Johnson Controls, you know, if the Fed starts increasing interest rates, I don't know. I don't have enough time to go through the fundamentals, but I don't know how much debt they're carrying. And if interest rates start going up, the cost to carry their debt might have an impact on their bottom line. So you have to be really careful with that one. So that one's questionable. Let's put it nicely for you there. Okay, let's look at Maddox looking at silver, SLV. Let's take a look at that. Now, I have to disclose I have a fairly large position in silver, and I just bought more. So that's my personal position. Let me tell you why I bought more. And then, Maddox, I'll tell you why this isn't such a bad price. The gap, there's a gap down below the market right here, just pennies below where it's trading now. Do I think silver could go a little bit lower? Yes, I think it can actually, because the volume is increasing on the way down. However, once this gap fills, and I'm okay with buying it now because I know it's got a good chance of bouncing and off of that gap fill support. Once that gap fills, it's probably going to start moving back up. And so if you could buy it anywhere around 15.5 and sell it around 16.5 up here where the moving average would be, this rubber band effect is being stretched. You can see again, silver does not like to stay this far below that moving average. I mean, you could see here, back here, even going back so far as into last year, you could see it does not like to stay that far below the moving average before it starts moving back up. So silver, it's not such a bad idea to accumulate it, but I have to disclose this as well. I'm not trading silver on the short term. I am buying it as a long-term hold in retirement accounts for both my wife and I. So I still am feeling very, very good about silver as long as it stays below production costs. I feel that it's a great accumulation position. So if you're trading it, different story. If you buy it around here, you're going to have to put your stop somewhere below 1520, you know, to limit your loss. And so you have to differentiate. Am I going to hold it as a long-term investor, or am I going to trade it as a short-term trader? You have to make that decision for yourself. I'm trading it, or I should say I'm accumulating it more on the investment side. Okay, look at USO. I'm short, thinking it could go lower to weekly support. All right, USO, that is a candidate of ours, actually. The rubber band is being stretched, and the volume is starting to slip on the downside. What that means is the sellers are starting to slow down in their selling activity. Let's look at the weekly chart on this, okay? So you can see. Right now, USO is in a perfect trading channel right here. You see this? In a weekly chart especially, it's in a perfect trading channel. And if you look, see, if you're short, you got to be careful because you now have you have 5 red candles in a row on the weekly chart. 5 red candles. I'm going to go so far to say that I don't think this candle is going to stay looking like that. I think by the end of the week, USO could start to move up. Remember, this is a weekly chart. And by the end of this week, you could see a long shadow under that candle. If the week ends on Friday and you see that there's a long shadow below that candle, then Leslie, I would say take your profits. Where did you sell this short? Do you know? You have that price handy? Let me see. And there's a little bit of a delay there. Okay, there's a little bit of a delay coming from that side too. I was just asking Leslie where she was shorted. Okay. All right, so I'm gonna keep moving on. All right, so that would be a good idea to cover the short if you see that long shadow in there. Okay, now let's pick another stock. TGT. This is Jerry coming from Jerry TGT. That's Target, I believe, right? Yeah, Target Corp. And well, while we're on the weekly chart, isn't this something? Let me see. Are you short this one too? Oh, wait, you're long this, Jerry. Okay, Jerry is long the 55 options. So you're long out of the monies. All right. good news and bad news. Bad news is last week you had a bearish engulfing pattern, and for the past 3 weeks you've had bearish engulfing patterns. So that's the bad news. The good news is long shadow. Boom. Really long shadow. And again, this is a weekly chart, and there looks to me like there's another long shadow forming on the weekly chart. So going now to the daily chart, again, basically analyzing this, you got a gap above the market. That's bullish because it'll act as a magnet. So there's a magnet up here, and there's an unfilled gap up here, and an unfilled gap up here. The rubber band is being stretched in a very big way on the daily chart, and today's volume is a mere fraction of the volume from Friday. So again, Friday the bad news came out. They traded it all the way down here to close to 48, rallied it right back up to 52. And so the buyers are fighting back here. The sellers are giving up. That's what this means. This virtually no volume today compared to Friday tells us that the sellers are out of their position. So that's good. That means the buyers will start moving in. Okay. Greg is looking at Amazon, AMZN. Now, Amazon is an extremely volatile stock. I have talked about this one before. There's fan lines. These fan lines represent an accelerated trend. I don't want to complicate this too much, but today Amazon had a very long red candle. Even though it closed higher today, that red candle tells us that the sellers started the day up here and just continue to sell it down all day long. Look, you can see from the daily chart, this is Amazon. Oh, here's another delay. Here we go. All right, let that load. Can everyone still hear me at least? Okay. All right, I'm gonna have to go and check. There it is. Okay, so here's the Amazon. And you can see that today it started off high, and then throughout the rest of the day, it kept going. So you bought the $1,000 puts, the strike price 1,000. I think you're okay with that. But if you're buying the puts on that and it starts showing any kind of green candles above this 20-period moving average on strong volume, I would close the puts. I would get out of the puts, and if you could take a profit, I would do that. Okay. Boy, there's a lot of stocks on here. I'm falling behind. I got to keep going. Okay, TLT. This is coming from Ken. I think it's TLT. Let's see. TLT. iShares short. TLT. Ken is short. Target price of 124. I would go with that because this has a gap below the market. Number one. The price has gone up, but the volume is now dropping. That's a sign of weakness. You got a wide divergence from that moving average. It doesn't like to be stretched that far, so chances are it'll start pulling back. And I think you're in good shape with that short position. Just make sure you keep your stop in place, because if it starts closing over this high, Ken, that could cause you some pain. So be careful with that. Okay. Let's see. Leslie says, I am SCO from the highs. Okay, that was the answer to the other question. All right. Let's go to, I answered Greg's question on Amazon. Let's go to David, CMTL. Let's try that one. CMTL. Is this a U.S. stock, David? This platform is only bringing up U.S. stocks. All right, let's go to Costco. Charles, David, if you want to bring up another stock, it's a U.S. stock, I'll look for that, and I'll get you on another stock. All right, Costco, COST from Charles. Take a look at that. Oh, I know that's Costco. Come on now, chart. Internet. This has to be a weather issue, because I'm let me see if I can get another stock that I know comes up. All right. Can you all still hear me at least? Sound check, sound check. So sorry for this. Okay, you could hear me. All right. Let me try to. All right. What's going on there? All right, no charts now. All right, well, in order to, there we go, there we go, there we go. All right, let's see. I'm going to go back to Costco, see if that comes up. All right, here we got Costco. All right, now, obviously the stock is in trouble. It's looks like it's in free fall. The only good thing that I see, Charles, is that the volume is less today than it was on Friday. That's the only good thing that I see from a volume standpoint. This gap has already filled. Yesterday, I'm sorry, Friday, this gap has filled. Now, I hesitate to even think about jumping into a stock like this when there is such volatility. However, if you are willing to take a position in this, you have to. I mean, there's no negotiating the exit strategy. You have to say, I'm going to be out if it closes below whatever support level. This is a good gap fill support level. This is where I would draw my line for getting out if it goes against me. So if you are long this, or thinking about getting long this one, you got long shadows underneath, that's good. Volume is dropping, that's good. You got a gap above the market, that's good. You got a wide divergence from the moving average, that's good. But the stock could still go lower. It seems like all of the signs are screaming a bounce, a dead cat bounce, buy it, support level is there. But you have to buy it with a risk management plan attached to the buy idea. So if you buy it at 164, you're going to have to get out below 161. You got to put your stop below there. Or if you're going to use options, you have to say, okay, I'm going to take a long position using the options, but if the stock closes below support, I got to get out. And there's no negotiating that. You have to stick to that. Okay, so if you can promise me that you're going to manage your risk, I'll promise you I'll be back next month for another weekly, another open house. Okay. All right. Let's see. Let's see. David has, I'm sorry, David has AAOI. Again, I'm not familiar with that stock symbol, AAOI. Hopefully it's a U.S. stock. Yes, it is. Now, this one is interesting because it's bouncing off of a role reversal support level. You see right here, former resistance, once broken, turned to support here and here. So you got a clear level of support. So that's good. So if you're buying this one, you have a place for you to set your stop. So I would put a stop somewhere around 56. And if it's, I know 56 is a long way from 63, but just buy less shares. Stay within the 1% rule. With this one, though, I don't see too much upside, only because it looks to me like the stock is repeating the pattern from back here. So I think for the short term, it's probably going to go up, hit that 20-period moving average, and then come back down again before making another attempt to go up. So I don't see a big upside stretch there. Now, if the stock closes over the 20-period moving average like it did back here and then bounces off that moving average, you got another shot. But to me, this whole pattern looks like a repeat of this, almost identical. So be really, really careful that one. If you long it, protect it. If you're thinking about buying it, keep your exit strategy tight and take your profits quickly. That's what I would do. All right, Mike is looking at HMY. HMY. Let's take a look at that one. Harmony Gold. All right. This one has lower volume on the way down. That's bullish. The rubber band is being stretched from that moving average. So that's a wide divergence. That's bullish. I don't see too much support on this chart, so I have to go back to a weekly chart to see where there might be some support. And the only support that I see is from back here. So that's a support level where it bounced, and then it broke back up. So this is still an intact support level from this bounce back here. So the only thing is, Mike, I really don't like these cheap stocks because the institutions don't support them, and they're manipulated a lot of the time. I mean, look at the volume. The average volume here. well, the volume isn't too bad. Let's see. Yeah, you got a lot of volume there, but it's just such a cheap stock that, you know, you could have someone put $1 million into this on the institutional side and they'll push it up $1. You know, so I would be really, really careful with this one. If you are long this one already, on the weekly chart, you see there's an open gap right there. Let me move in. I'm just going to go a little bit over because of the technical hiccups, folks. So bear with me on that. All right, so there's still an open gap up here. So that would be my target exit strategy. If I were in the stock, I wouldn't buy it, but if I were, that would be my exit price, because you have 1, 2, 3, 4, 5, 6 red candles in a row. You're long overdue for a green candle, and it's on a major support level on the weekly chart. So you got some things going for you there. Mike, I'm going to put you on the spot. Where is your stop loss order on this one? Do you have a stop on it? Yes or no? And if yes, where's your stop? I'm gonna put you on the spot. Yeah, that's right. It's all about risk management. I don't want you to hurt yourself. That's why it's kind of like, oh, you got a nice job. Got to stop at 150. I like it. So that's below the support level. Great job. Okay. All right. As long as you got your stop in and you see a clear place where you're going to be exiting for a profit up here, good. You're good to go. Okay. Let's see. Who wants to put one more? A GILD. GILD. It's Gilead. Ken is long and it's 60. It's 65. It looks like. All right, so you're long it right where the stock is. This is a weekly chart, not looking good. The weekly chart looks pretty unhealthy, actually, because for 3 years, it's on a 3-year low. That's not looking good. That's not the kind of trend you want to be investing in. You got to put your money where the money is going. Ken, I don't like this stock because of the long-term downtrend, but if you're long it at 65, I would say right here is going to be your target right around 66.5. I would not be holding that very long, because this is one of the stocks that could hit a resistance point and go right back down. They had a bearish engulfing pattern on Friday. It barely closed over the 20-period moving average. So if it goes up and then immediately starts closing below the 20-period moving average, I would get out. I would look for a better stock that has an upward trend or one that has stronger support on a weekly chart. That's what I would do. Okay, let's see. All right, let's see. Do one more. CVS. David is selling puts. Now, for those who are not option traders, selling a put is a bullish strategy. And when you sell a 70 put, you are basically obligating yourself to buy it at 70. And I would be okay with that, David. But how far out are you going, and how much are they paying you? Right now, the signs look bullish. It looks bullish. It barely closed over the 20-period moving average. I could get rid of these lines because those are old lines. I'm going to clear the drawing set and draw new lines for you. You got support here, right around 76. You got long shadows under the candle. That's bullish. You got a drop in volume as the stock was going down, so the sellers are losing momentum. That's bullish. You got a gap above the market. That's bullish. I think the stock is probably going to start moving up, but look at all the resistance it's going to bump its head up against. You see that? So while the stock is trading in a sideways range right here, you'll continue to make money by selling the 70 puts because time erosion will be on your side. So right now, there's nothing on the chart that tells me this is a threatening position based on what you have, and I think you'll be okay. So, folks, I just want to make a couple announcements before we wrap up. We are putting together an online course. It's a technical analysis course. It's going to be 20 classes, and it's going to be structured just like an online college course. So with 20 classes, and each class is going to be about 45 minutes long, we're going to be downloading that to our website upon completion. And I'm going to open up the course even before the last class has been recorded, because it's going to take some time for people to get through this. This course is not going to be free, but it's going to be reasonably priced. I'm just giving you a heads up right now. Everything that we do at the Market Guys is quality, and I'm looking for students that might be interested in participating in that course, so I can get an idea of how many classes I should get into before I open it up. So if you're interested in such a course, I'll send you the details. Just email me, AJ at the Market Guys, and I'll be more than happy to give you that information on what the how to access it and what it looks like and the topics that we're going to be covering within the technical analysis curriculum. The other thing is I have 2 spots on the mentoring opening up for those who have never gone through mentoring. I would encourage you to do that. I have a few people have gone through mentoring who would be more than happy to give you their input, their opinion on what they've learned and how they learned it. I don't prep anybody with that. I just have them reach out to you, or you reach out to them. If you're interested, again, I'm only taking 2 people into the next class. Again, email me and just send me the question, or say I'm interested in mentoring, and I'll explain that to you as well. I think that now on the political forefront, it doesn't matter what political flag you fly. I think we could all agree that our president is up against all kinds of obstacles. I mean, everything. You name it, they're throwing it at him. And I don't think that his economic plan is going to move forward. As much as I want our economy to thrive, I don't think it's going to move forward the way he wants it to move forward. I just think that there's just too many obstacles. So when you look at the Dow and you look at the Russell 2000, and you go and you look on even on the monthly chart, I think this is the second longest bull market in American history from 2009 to present, second longest bull market in history. And every single bull market that we've ever had since the market has been around, every single bull market has eventually come to an end. And when it came to an end, it came to an end in a very dramatic way. Major collapses in prices, major damage being done by people that didn't protect themselves. Now, am I saying it's going to end today, tomorrow, this year? I don't know. We don't know that. But I can tell you that it's going to end. So when we look at anything on the long side, we have to be very, very cautious buyers and make sure that we're protecting ourselves with very tight stops. The option traders are going to have it the best. They really are, because they have a leveraged position that also limits their risk, but it increases their profitability in a percentage level if they capture a sell-off. Like Greg, who mentioned he's long puts, he's going to make money on the way down if that stock goes down. And so what I'm encouraging everyone to do is to just kind of go through your risk management plan that you have set for yourself. Make sure it's intact. Make sure you're staying disciplined to it. Make sure you're staying connected to the weekly market reports, and just don't ignore the signals. Don't fight the market. If a stock is going against you and you're holding a losing position, don't fight it. Just get out of it and start over again and chase the profit back in a different stock. That's the best advice that I can give any of you. And so I'm really happy that we're able to get through this one with the technical challenges that we had. Went a little bit over, but I really look forward to continuing to connect with you on all the different levels through the reports and through the courses and the mentoring that we offer. So again, if you're interested in anything that I mentioned, just email me. I'll be more than happy to call you maybe sometime during the week to explain, or I can send you back a response via email. It's up to you. All right, folks, have a good night, and we'll talk to you. Bye-bye.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.